Hello and welcome to the Monday Futures Market Outlook for March 11th, 2013. This is Patrick Sresna. As always, we start off a chart of the US dollar index futures, and we've had a substantial breakout on the upside of the US dollar as we've seen deterioration in a lot of currencies, particularly most recently the euro and the British pound. At this juncture, this really has set in motion an uptrend that certainly can be targeting the overhead resistance levels at 84 and a quarter on the upside. On the short term, we are a little overbought, and there certainly has lots of potential for pullbacks down toward the 81 to 82 level on the downside. But so long as all selling is contained, this new trend could continue to be strong. Next year, when we take a look at the euro futures, we can see that the euro has continues to consolidate down at technically poor levels. This continues to leave the window open for further weakness, as the euro can easily deteriorate down toward its November lows around the 127 level on the downside. We're watching to see whether or not the 130 level breaks. If it does, look for that selling to accelerate even another couple hundred pips lower. Next year, I want to take a look at the 30-year Treasury bond, and Treasuries have had a substantial rally, but have given it all back recently as there has been more and more new news coming in regards to Fed policy and the way interest rates will keep moving forward, particularly with those job numbers and so on. Really, at this juncture, this is going to be a key critical test, because if the Treasury bonds break to a lower low, our entire thesis of a short-term low on the 30-year bond would have to be reevaluated. If for whatever reason we did have that breakdown, there are still some support levels just a few points lower, so we're not looking for a substantial decline, but it is a critical decision point. We still think that the Treasury bonds have a very good chance of moving counter trend to the market, and so we'll be watching as to when bonds are rallying as a signal as to when the stock market is potentially ready for rolling over. Next year, I want to take a look at copper futures, and copper really has continued to be very weak. A lot of people look at copper prices as an indication of the strength of the global economy, and with the further weakness in copper, it just shows that the commodity complex is very range bound. Really, at this stage, we are starting to approach some important support lines on copper. So while the selling has been clear, we do believe some of these support lines will act and contain copper selling. Now, if we're approaching those November lows right around this 340 level on the downside, so we'll watch to see if this support can hold here for a short-term bounce. Next year, I want to take a look at crude oil, and crude oil is even a more mixed picture than copper. Really came off the top of the ranges and has not even approached the bottom end of the range down in the $85 level on the downside. We're sort of right in the middle of this sideways range. There's plenty of room for there to be a short-term bounce on crude, but at this stage you have to take a very neutral stance. We don't believe that there's a bullish case that we'll see crude exceed the highs in the 98 to 102 level on the upside, but at the same time there may not be enough catalyst to weaken oil down to the 85 level, so we could get a lot of fake out moves around here, $2 higher, $2 lower, with very little conviction. But if I was to have to be cornered into a bias, there's still room for oil to test those November lows down at the 85 level. Next year, I want to take a look at gold futures, and we were clearly too early a month ago when we were looking for those Fibonacci levels to be holding around that 1650 level and looking for a reversal higher. Gold has subsequently broken down and is testing its 2012 lows around that 1550 level. This is a place where gold has got to make a pretty important stance. If this is really just more range-bound price action, then this support line should contain almost all of gold selling, and we should see an extended period of consolidation throughout the month of March, within an $80 range, more or less, in this zone. If we saw any substantial material breakdown of gold below 1550, we would have to rethink that storyline. But really, at this stage, we're going to go with a sideways range-bound market for the month of March, as gold is going to have to bang out a support line down along these bottoms. Finally, when we take a look at the S&P 500, last week we drew on that scenario where we'd have even potentially a break to a higher high and it reject. And so let's see whether that storyline finishes playing out like we drew it on. Really, at this point, we're now seeing the testing of that 1550 zone on the upside. And if for whatever reason there's a catalyst within the market that would create a sell cycle that brings us back down toward 1500, then we'd have to start looking for topping formations. Really at this stage, though, there is no evidence that that scenario has begun, and so we don't want to speculate at this stage. There clearly the uptrend is in place. There are very key highs up in the 1575, 1585 area that are the all-time highs on the S&P. There's a lot of traders that may be watching that as a psychological level to gun for some short-term strength. So we don't want to overly weigh the bearish scenario here. We see very little to almost no a reason to want to being in the stock market here from a risk-reward perspective. Really at this stage, sitting on the sidelines and being patient, waiting for a traditional market pullback remains our stance. Just to review our key intermarket observations, the U.S. dollar we still consider relatively range-bound. Even the short term has been in an uptrend. We at some juncture here during little pullbacks, we're going to, if the support holds, we're going to change our trend to actually an upwards trend versus range-bound. At the same time, the short-term risk-reward proposition would become good if there was a pullback in the U.S. dollar that found support. And when it comes to commodities, we also see very little trend, and it's just gravitating to the bottom end of its ranges. At the same time, it's not a poor risk-reward proposition anymore, as much of the downside has already occurred in the last month. From a bonds perspective, while over the long term we actually are quite bearish bonds, as we believe it's being artificially held up by the Fed policy, and in the bigger we are still looking for further Fed intervention, so we don't believe that the bonds are in a position to correct. So at this stage, at some point, there will be an asset rotation out of stocks and into bonds, and so these cheap bond prices down here are starting to represent good risk-reward proposition along those bottom line supports. As for the stock markets, both U.S. and global stock markets, they remain very distinctly in an uptrend, but the proposition from a risk-reward perspective remains to be really poor. In fact, if the markets remain up at these levels even for another week or more, we may even change that ranking to very poor, as there might only be as little as 50 S&P points upside potential for well over 100 S&P points corrective risk, and so it's something that we should be paying attention to. That was your Monday Futures Market Outlook. Thank you for joining me.